Hey guys, it's the Simple Investor here. Today we're going to be taking a look at Google stock, and I'm going to be giving you an evaluation on whether I think the company is potentially undervalued right now, fairly valued, or overvalued. The company has been kind of on a downward trend this week, just on the news of the antitrust suit against them from the Department of Justice, where the Department of Justice and the United States government ruled them to be a monopoly on the internet. But before we get started, be sure to like this video and to subscribe, as it really helps the channel out. Well, let's get started and let's get looking at Google's balance sheet currently. They just reported earnings in July, so these numbers are nice and new. You can see here they had nice double-digit revenue growth. Their net income was up quite nicely here as well, just in June. And then their net profit margin, again, growing at a double-digit rate. So that is quite nice. And then earnings per share here, again, up 31% here. But again, you always want to be wary of this when companies are very friendly to shareholders and they do stock buybacks. This is always going to be masked by that. Again, their EBITDA is also nice to see. But again, these companies have really high margins. So again, the EBITDA isn't something that I'm too concerned of. And then down to their balance sheet here as well. Again, these tech companies and these Magnificent Seven companies have very, very strong balance sheets here as well. You can see that this total assets to liabilities creates a nice debt to equity ratio. And then as well, down to their cash flow, this is something that I really like to watch for, which is their free cash flow. And you can see here their free cash flow is down. That is not something that I'm too concerned of. We'll get into why their free cash flow is sinking a little bit, but that is not something that I'm concerned about. But you can see here, actually, they had a net change in cash here as well. That is due to high interest rates right now. We'll get into the visuals of it, but Google is actually making money from just having cash and having a cash pile, because, as you know, interest rates are at 5% right now in the United States, and they are collecting 5% on that. So that is actually helping their bottom line. But let's get into some valuation metrics here. So Google's PE, this is one of the things that you want to look at if you're evaluating whether a stock is undervalued, overvalued, or fairly valued. It's the relative PE. And currently Google's got not a bad price over earnings ratio here. Their forward PE is actually sitting lower. This is their trailing PE right here. So their trailing PE is sitting at 24.38, which for them is actually quite low considering what it was in years prior. So you can see here in 2020, their PE was sitting close to 30, came down in 2021. And then in 2022, when we had a bit of a sell-off, it actually sunk below 20. So their PE is actually sitting at not too bad of a rate. It's starting to creep up a little bit just on kind of the fuel of the market this week. Even though the market was down, it ramped up to close today. So again, their PE is kind of sitting at not a bad rate for them. But again, one thing I do want to point out about their PE is I find that these tech companies, again, their earnings are highly reflective of the interest rate and macroeconomic situation at the moment. So you can see here in 2022, and then even prior in 2021, they were really, really expensive, and there was a lot of money going into the stock market just because interest rates were very low at that time. So there's more spending, debt is cheaper. And then you see here as we started to get into a more monetary tightening going forward, you can see here earnings were down as there was a lot more tightening going around. There's not as much investing going on. When you can collect 5% with a treasury bond, or things like that, and people are watching their money as well in a highly inflationary period, the earnings aren't reflective of what analysts would expect. So again, that's why you're seeing a higher PE here as well. And then again, it's actually starting to come down a little bit lower here as we start to get into more monetary easing coming up. So that is also why these price over earnings ratios kind of vary a little bit, is just due to the cycle of the economy. When spending is rampant, these companies tend to be a little bit overvalued, and they start to get a little bit more value than what they're actually worth. And then you start to get down here, there's a lot more sensibility in their earnings, and their earnings are actually a little bit more reflective of what their intrinsic value is as a stock. And then going further here, I want to touch on their debt to equity ratio, which we touched on a little bit previously. But again, just to kind of visualize it, Their debt to equity ratio here is actually reducing here. Google has an extremely strong debt to equity ratio. You can see here they have equity, shareholder equity of close to $300 billion, and their long-term debt only sits at $13.23 billion. So that is extremely a strong debt to equity position. And as a shareholder, that's what you want to see, because that's your equity as a shareholder. And that allows them to spend on future things and to keep a nice reserve chest in case things ever get rocky for them, which we'll get into how that might be a possibility. But going further here, this is another thing I really like to look at, just because it helps visualize where their revenue is and how their revenue has grown year over year. Because a lot of the times, if you're looking at certain metrics, you can see how you might not see growth, or you'll see growth, and it's kind of masked in between how they're measured. So this way, it actually really presents it nicely here. And you can see here, if we start looking at the last 12 months here, you can see how there's been just a gradual nice increase in revenue. And Google is a $2 trillion company, has a $2 trillion market cap. And so one of the worries with the Magnificent Seven stocks is that their growth is starting to stagnate. Apple, for example, has stagnating revenue. Their revenue cannot grow. It's been stagnant for the last year. Again, that is highly reflective on the current macroeconomic situation in terms of a tighter monetary policy. Higher interest rates means people aren't buying iPhones because debt is more expensive to buy that iPhone. So Google here, though, has still, even in this tight monetary period here, has still been able to deliver growing revenue here. You can see they've grown year over year consistently, and then quarterly here. Quarters have been kind of off and on, but again, when you're looking at these quarterly revenues, you have to remember that every quarter is unique and measures a different time just in the economy. So it's not always going to reflect actual performance. Where you really want to see it would be looking at the trailing 12 months, and they've been able to just compound revenue growth constantly. And if we actually look at it a year over year quarterly growth measure, you can see here where there was exponential growth here. Again, that was just because we had a looser monetary period where interest rates were extremely low coming out of the pandemic, and they were able to grow at a very rapid pace just because they had access to cheap debt, and more people were spending money, and they were taking advantage of that. And we'll get into kind of how they make money coming up here. And then you can see here, their growth has been very limited and has been slower. Again, they're still posting double-digit growth here, and their growth is starting to ramp up here. You can see that it's actually started to creep up quite nicely. It's actually doubled here from what it was last year, which is quite nice, at 15% here, just about a year. But that is quite nice to see there. It's starting to kind of ramp up to what it was when the economy was in a loosening period. So that is also very nice to see for their revenue. And then one thing that I do like to look at is kind of, I like to visualize how they make their money, because that's really important when you're evaluating whether a stock is fairly valued or undervalued or overvalued, is taking a look at kind of the totality of things and seeing where their revenue actually comes from, how that actually goes into their costs of doing business, and then how that actually correlates into their profit. I think that's really important for investors to see when you're investing in a stock, because numbers on a page don't tell the full story. Actually seeing it will help make you more sure of your investment. So if we take a look here, you can see the bulk of their revenue comes from Google search here. And again, this is why the stock is highly sensitive to the macroeconomic situation, is just because when companies and people have access to cheaper debt, they're more inclined to take out money to pay for an advertisement because the economy is in an expansionary period where it's looking to expand. And you see here that this here is the bulk of their revenue, and that is super important for them as a revenue driver. So again, that was up 14% year over year. YouTube as well, as you know, Google owns YouTube. That contributes to their ad revenue as well. So again, you can kind of think of these two as highly correlated to each other. And you can even see here they have some other ad sources here that are also related to their ad revenue here, creating majority of their revenue coming from just pure ad revenue from traffic and volume on all of their platforms. Again, that as a total was up 11% year over year. And then their other spending here. Google Play, so that would be more the watches and their hardware products, as well as their subscription services. That was up a nice 14 percentage points year over year. And then Google Cloud here, which is something that they compete with Microsoft and Amazon, Microsoft's Azure and Amazon's AWS. This was up an impressive 29% year over year. This is something analysts have been really watching to see how they can grow Google Cloud, because they see it as a high margin business, which means there's potentially more profit that can be made off of Google Cloud, where these we'll get into here shortly are starting to they cannot rely on their advertising business as much going forward, just because of the recent ruling. But I want to visualize here too what Google Cloud has done for them and how it's actually grown, and it continues to grow. And I think it's actually just now starting to enter into its growth phase. So if we take a look here, you can see when it really, when it was in its infancy stages here, it wasn't actually producing them any profit. It was actually costing them money to do business. But you can see here, as the quarters have gone on, it's delivered them profound revenue, and they're starting to actually gain good, decent operating income, which correlates into profit for them. So this is nice to see, and this is actually really nice growth. If you're an investor, this is something you want to see. They need to grow it very quickly, just because of what is coming for them in terms of their antitrust suit against them, which was just this week. This antitrust suit here is where the U.S. the Department of Justice alleged Google having an online monopoly for Google search, to which the courts ruled that they did in favor of the Department of Justice's case. And so basically what that means is Google is, I would say Google isn't going to be as directly affected as people think, but what it means is there's going to be more competition for search and other search engines. So what this might mean is, as you know, Apple pays $20 billion a year, and other companies Google pays those companies billions of dollars every year, like Apple, Samsung, and different hardware users, to have the default search engine as Google. This is something that I see changing down the road, where Google won't be allowed to pay these companies to be the proprietary and only search engine on that platform, or the default search engine on that platform. What you will see is a bidding war between different search engines, so like Mozilla, Firefox, as well as Bing, and then of course SearchGPT, OpenAI's AI search engine that you're seeing. Those will likely start to, and Google will bid to be the default search engine on a device. So that is something that I think will happen. I think it's blown out of proportion, because what you're seeing is a lot of fear that Google's just going to disappear, and this is going to affect Google's revenue and its bottom line, and it's going to eat into their profit margin. I think that is blown way out of proportion, because Google is still basically the internet. When people talk about the internet, they refer to it as Google commonly, and people are still very comfortable with Google. I think Google has a very sticky moat in terms of people have used Google, they use Gmail, they use YouTube. They are still very entrenched into Google services. So whether it's been ruled a monopoly, I think is beyond the point. It's not going to change people's habits. People obviously like Google. Just because it's a monopoly doesn't mean people are going to stop using it. So I do think it will eat into a little bit of their ad revenue if there are some really punitive measures that come of this, because the measures have not been fully announced as to what the government is going to force Google to do. But it'll be interesting to see how that actually unfolds. Like I said, my speculation is that you'll see a massive bidding war where Google, Microsoft, OpenAI, and all of these different search engines are going to have bidding wars with companies like Samsung and Apple to be the default search engine on those hardware devices. So that'll be interesting to see moving forward. And one thing I do want to go back to here is we were noticing how their free cash flow here was decreasing. So you can see it was down 34%. And what that is fueled by is them funding their capital expenditures. So majority of Google's money, like every other tech company right now, and all of their capital expenditure spending is going towards AI. How can they monetize AI? How can they improve services and increase margins? So all of that is going into AI, and what they're buying is they're spending it with NVIDIA. So they're spending money with NVIDIA, and what they're buying from NVIDIA is they're buying their Blackwell GPUs. They're basically leasing out data centers to run these complex queries for generative AI, and then these GPUs for training their large language models like Google's Gemini, and then of course OpenAI. They're all using these NVIDIA's GPUs, and they're using NVIDIA's data centers. So that is where that money is going, and you can see Google here. It makes up actually almost 7% of NVIDIA's revenue. And that is quite significant when you look at the scale of things and how quickly NVIDIA has been able to grow just in the past 2 years alone. So that is something to keep an eye on. And like I said, NVIDIA is an interesting company because they right now have a monopoly on the whole data center and GPU, AI GPU manufacturing, where they control 90% of the market. So in a sense, they have a monopoly right now. And what I find really interesting is seeing how that's going to unfold over the next 20 years. Like I said, NVIDIA has extremely high margins on these GPUs and these data centers that they're producing for these tech companies to buy. Like I said, I just don't, especially as we enter into this period of monetary easing when debt is going to be cheaper, I just don't see how these companies are going to look at their balance sheets every quarter and justify spending this amount of money and paying that amount of a margin towards NVIDIA's bottom line and their profit. I just really don't see how that's sustainable for them long term. And then on the other side, I just don't see how companies like AMD and other companies aren't going to start to ramp up their spending to try to compete with NVIDIA. I mean, I know NVIDIA is in a unique position because they are kind of at the forefront of this AI GPU manufacturing and access to data centers. But it'll be interesting to see kind of where this takes it. But for Google, they also are investing with that AI into some of their other more potentially disruptive technology endeavors, which would be like Waymo, so self-driving. Obviously, this is something that they see as a disruptive, potentially future growth driver for them. This directly competes with Tesla's full self-driving. So again, for Google, they're invested in some potentially very disruptive technology. They're heavily invested into AI. They're investing into self-driving, which are arguably the top two life-changing things that can take off in the next 20 to 30 years, where there's could be the potential for significant return on investment. And they have, obviously, that like we were looking at, they have boatloads of cash they can throw at this. And at this point, at Google scale, if it's not $1 trillion idea, they're not going to be investing in it. So again, this is something you want to look at as an investor, and they are expanding to multiple cities as well. They just announced yesterday that they're expanding into certain new areas in Los Angeles, and then as well in San Francisco. So again, these are things that you really want to be looking for. What are these companies invested in that are potentially disruptive? Because they might be investing in certain things that are right now revenue drivers for them, but they're not disruptive. Ads are not disruptive for them. It makes them money, but it's not disruptive. You want to invest in companies that are investing in disruptive technology, technology that will change the world and potentially drive them to new levels. And this is what AI is doing, and this is what self-driving is. These are the top two things right now, and you can see Google is spending an absurd amount of money on both. But this is what you want to see as an investor, because when you buy a stock, you want to hold it for 20 years. You don't want to just trade it. This is the kind of investment you want to make if you believe in the company long term, and you want to ignore the little fluctuations in price and the noise that is produced. Like, to me, this is just noise. The ad revenue being disrupted potentially by Google being ruled a monopoly. Like I said, it's very sticky. what happens is very murky. Nobody really knows. The government hasn't said that you can't use Google anymore. Apple, Google, you can't pay Apple anymore. Nothing like that has really come to fruition. Until that is more set out, there's really nothing that's changed for Google. And currently, right now, Google sits at a very attractive valuation, like we were looking at here. They're at their pretty much just a little bit lower than their average for price over earnings ratio. But again, they're a very attractive company. They have very, very solid revenue growth. And if we look at all their growth, it's double digit across the board. Here, you still in a time when analysts did not like this last earnings call, did not like their ad revenue, they still grew it by 11% as well. Google Cloud is really growing here. So again, this company is still growing at a massive scale. And you did see some nice growth in their net profit again. I mean, 3 percentage point year over year isn't great, but that is something as well that is still really impressive. And then again, this other, I was mentioning earlier how they're making money off of the current high interest rates. You can see here they actually made $100 million off of high interest rates. So again, these are things, this is why right now Google looks like a very attractive stock right now, is because there's a lot of noise. But if you kind of drown out that noise and you really look at the business as a whole, and you look kind of look forward, the company isn't going anywhere anytime soon. They have a sticky moat. They have lots of users. They're growing double digits in all their main revenue drivers. They're investing in disruptive technology. They're investing heavily into AI. The future is really bright for this company. For me, I see the stock as a very attractive play right now, just because it has a lot of growth ahead of them. I mean, they had so much cash that they started offering a dividend on the, it's not much, but they started offering a dividend to investors. And I think it actually equates to under 5% of a payout ratio. Like it's maybe a little more than that, but it's not much at all. But again, this is a company that really has the potential to offer profound growth for the next 10 to 20 years. But I'd love to know what you think. Is Google a buy? Is it a sell? Or is it a hold for you? I strongly think it's undervalued right now. I think that there are several things going for it. There are also several things going against it right now, especially with that noise on the DOJ's case. But I'd love to know what you think. It's a stock, personally, I'm adding to right now. But let me know what you think in that comment section below. Be sure to like and subscribe if you haven't already, and we'll see you guys next time.